Well, the third largest bank in Europe has agreed to buy its troubled rival, Credit Suisse. Swiss authorities urged banking giant UBS to take over the smaller bank after its shares plunged last week. The deal, topping $3 billion, did not prevent Credit Suisse shares from plummeting further this morning. Meantime, in the U.S., a new study reveals nearly 200 banks are at risk of failure due to rising interest rates and a high proportion of uninsured deposits. Tech lender Silicon Valley Bank collapsed last week after parking much of its cash in long-term government bonds, which were also subject to the nation's rising interest rates. And joining us tonight to weigh in on these headlines and more is Joel Griffith, research fellow at the Thomas A. Roe Institute for Economic Policy Studies at the Heritage Foundation. Joel, great to see you. A lot to unpack here, but first, let's start with Credit Suisse, a heavy hitter on the global front. What's the significance of this deal with UBS, and why does it matter?
Well, we should all be concerned with what's going on in our banking system right now. Whether we're talking about Credit Suisse or the two banks here in the United States that failed over the past week, this is a situation where banks in the United States and across the world put depositor money in what were considered to be safe investments. And those safe investments I'm referring to are things like long-term government debt. Now, economists that believe in free markets, such as myself, we warned in the past that this is a risky investment because, look, as governments take on more debt, there's the risk that central banks will print money, making the value of our dollars or the euros worth less and less in the future. This is exactly what we saw happen over the past 2 years. As you saw interest rates rise in response to all the higher inflation, that meant the value of that supposedly safe government debt that these banks bought, the value of the government debt plunged in value, and depositors, both at Credit Suisse and also at SVB here in the United States, depositors realized that if they were to yank out the deposits from those banks would have to sell off these investments at a big loss and might not be able to cover the depositor demands. That's why we're seeing these banks fail.
Joe, I want to get your take on this. We've been assured by the president and also the Treasury Secretary that all is well here in the United States and our banking system is solid. What do you think? Is that accurate?
No, all is not well in the United States. Even above and beyond the banks that are failing because government debt is plunging in value, and that's what banks typically hold as safe investments. Even if your bank doesn't fail, your deposits aren't so safe because your deposits are diminishing in value. I challenge anybody, take a look at your Wells Fargo or Chase account, wherever you have your money in your checking account. You're probably getting about 1/2% interest per year on your deposits. But each and every month, the value of your dollar is shrinking by at least 1/2% on average. That means over the course of a given year, if you have $100,000 in your bank account, your $100,000 at the end of a year, thanks to inflation, is only worth about $90,000. So we are all at risk because of this rampant government spending that's been passed by Republican and Democrats, and our central bank that is largely responsible for these bank failures. Our central bank has printed trillions of dollars to buy all of that government debt, and we are all poorer as a result because of the higher inflation, and now, of course, because of this very troubled banking sector.
Well, Joel, this sounds really concerning. I mean, what can we do? Is there anything that we can do?
Well, I think, number one, let's remember, if you have money at a bank, you are insured up to $250,000. Of course, that doesn't insure you against the inflation risk. But I think what longer term it has to be done is Congress needs to realize that they cannot continue to spend beyond our means. There's no way that we can raise taxes sufficient to pay for all of this spending without collapsing the economy. And if you turn to the central bank to continue printing the money, you're going to see the middle class devastated with higher inflation. We have to get spending under control, number one. And number two, Congress needs to rein in the power of the Federal Reserve. Over the past 3 years, we have seen the Federal Reserve print trillions of dollars, equivalent to more than $150,000 per family of four. They bought everything from corporate bonds to mortgage securities to government debt. It has wreaked havoc on our economy. Congress needs to rein in the power of the central bank before we experience even more economic devastation.
All right, Joel, we're going to leave it right there. Thank you so much for weighing in. We always appreciate your insights. Thank you again.
Yeah, thanks for having me tonight.